Today, we're going to explore something that historically has been closed off to most advisors and investors, and that is investing in the business of sports and the opportunity that it presents. So, this really isn't about fandom and the pomp and circumstance that comes with sports and the winning and losing of sports, but this is really about viewing sports as an investable asset, as something that is kind of analogous to investing in a sector or even in a specific fund or company. Today, we are joined by two individuals that were very instrumental in making all of this happen. By way of introduction, my name is Tyler Resch. I'm the Chief Growth Officer, and I am joined by Steve Dimant, who is our Director of Alternative Solutions, and Maz Ajelbeji, who is a Chief Investment Officer. Welcome, gentlemen. We look forward to having you a part of the conversation today.
Thank you, Tyler. Look forward to participating.
Thanks, Tyler.
The areas that you see on the screen here, we're going to cover these four pillars in rather short order. We're going to talk specifically about why investing in the business of sports makes sense. We're going to talk about some of the institutional growth drivers behind the business of sports. We're specifically going to talk about our fund that we've created, which is the Goal Line Growth Fund. And we're going to talk about how it might fit into your portfolio and next steps to take advantage of it. So the business of sports has really evolved, and it's, for decades, it's really been a situation where it was for billionaire owners that were really owning a prized possession, which was a franchise. But something remarkable has happened over the last 15 years or so. And more currently, over the last several months, we've seen this accelerating trend. And that is billionaires are now looking for outside capital. And the billionaire ownership model has really changed to a syndicate model where there are multiple people involved in the ownership structure of franchises. Not to mention that there's other opportunities beyond just the team that takes the field on a Sunday afternoon, for example. And there's business opportunities well beyond that, whether it's the media rights or the technology. And so institutional capital has taken notice, and they're entering into this space. And what we're trying to accomplish through the Goal Line Growth Fund, and there are some other funds that are out there as well, is that now we're offering RIAs access to this opportunity. And so when you look at the business of sports and you look at sports as an emerging asset class, everything that you see on this screen, which is a very busy screen, and we're going to unpack all these elements in rapid succession, but I want to share just some key pillars around what the business of sports means. And I want to bring Maz into this conversation as well. But let me just start off by talking about the franchises, because we know this is the prized possession. This is what the billionaire owners always were after. And this is actually where a lot of the revenue of the industry is generated. It's not solely where it is, but it's no surprise that it is, because really looking over the last 2 decades, we've seen about a 14% annual growth rate of what these franchise values are worth within the NFL specifically. It's been an incredible run. And again, sports used to just be about owning this valuable asset, but now owning business and being affiliated with the business of sport, owning a sports team, I should say, is really a business proposition that can't be ignored. And what we're starting to see are areas of it's low correlated to the general stock market and the macroeconomic trends. There's media rights that have proliferated throughout non-traditional media. We're going to unpack a lot of that today too. And like I mentioned, institutional capital. Maz, I want to bring you into this conversation because this is really something that you identified early on as an opportunity for this fund. Is there anything that sort of stands out on this slide that you want to share with the audience today?
Thank you, Tyler. In addition to what you mentioned, I can also add some additional reasoning on why sports is emerging. First, let's talk about globalization of fan bases around the globe, obviously. It's accelerating dramatically. Leagues increasingly monetize international markets through merchandising, streaming, global games, expanding far faster than any domestic league only. When you're talking about digital enhancement, is creating new revenue lines, the rise of sports betting, fantasy platforms, micro content, social media monetization. All these enhance the EBITDA beyond traditional ticketing in broadcasting. And then finally, when you're looking at, really why sports, look at the structural scarcity sports with zero new primary issuance of major league sports franchises. When you're looking at the NFL, when you're looking at the NBA, Major League Baseball, we're not adding a lot of new teams. So the valuations of these teams keep increasing year after year.
Yeah, and again, we're going to unpack a lot of this, and it's an incredible opportunity that we see. And again, we're very, very excited about being able to package this up for retail investors to enjoy beyond just the billionaires that have experienced this in the past. So, really the characteristics of the market, we touched on this a little bit, but it's somewhat non-cyclical. And so what's historically been proven is that attendance for major sporting events has historically been very robust, even in downturns or even in cycles that are fraught with volatility. The other area that is really interesting to unpack, and I know Steve will touch on this as well, is just the area of recurring revenue. We all know recurring revenue as advisors, and we know that to be a much superior revenue stream. Well, sports experiences as well, because again, it's not just about selling tickets for the game that occurs, but it's the media rights. Media deals oftentimes are upwards of 10 years. Naming rights of stadiums, we're seeing upwards of 30 years. Sponsorships are around 3 to 5 years, and some leagues even have rev share that is an annual occurrence. We touched on the global reach and we touched on the scarcity. The numbers to point out here in a lot of details, there's only 151 major pro franchises. And there's really been no IPOs, maybe the Green Bay Packers being somewhat of an exception to that with their novel ideas in the past. But there's not IPOs where we can jump in like a stock or a company would issue. Looking at it through a different lens, comparing some of these metrics from where it was and where it is today, we're seeing some really impressive attributes. The franchise growth, really was never measured. It was never really a measurable thing back, 20 years ago, because again, they were closely held. There wasn't any formal reporting structure or anything of that nature. Well, again, what we're seeing is 12 to 15% annualized in the NFL, and major other sports network or major sports leagues experience something similar. There was no real private equity ownership in pro sports. It was very rare. Now it's very common. And we're going to get into this one, but it's the media buyers. We're seeing, more than just CBS, NBC, and ABC and ESPN being a part of this. And we're seeing, some of the new media, the streaming media get involved. Taking a different lens is just looking at this on a chart. If you showed this chart in front of your clients and said, this was your investment from 2020 to today, and it went from left to right in an upward trajectory. Now, I know MLB is a little bit flat there. That's the blue line. But again, we're talking about values in the billions here. These are billion-dollar companies or billion-dollar opportunities. If you look at it through the lens of an investor, everybody you'd show this to would say, this would be great. This would be a great return for, my investment. So again, just another way to look at the four major leagues in a different light. Moz touched on global growth, and global growth is really an interesting phenomenon because it does seem to have some starts and fits as it did maybe many, many years ago. But, as we know, the world is very flat now, and there's opportunities in all corners of the earth for a lot of these sports to proliferate. But what we're also seeing are sports that originated maybe in Europe or elsewhere that are coming to the United States. And so there's almost this like back and forth deal that's occurring across continents. And this slide highlights a few of them. So the MLS has not necessarily expanded beyond North America, but what they have done is they've attracted interest from Europe and from South America by bringing in the likes of Messi to the Inter Miami team. Thomas Muller came over from Germany to play for the Vancouver Whitecaps. And that's, obviously having a waterfall effect with respect to fan base and fandom. You're getting people tuned in to what historically has been, maybe a second tier, third tier type soccer environment, watching it, at the highest level with these players. NBA announced a deal in Africa, and the games are being broadcast on ESPN Plus. It's attracted the likes of Barack Obama as an investor. The F1 is one of those situations where that originated elsewhere, and now it's sort of been brought into the United States, and we've adopted it as one of our own. Obviously, with a lot of different media opportunities around that, with Netflix shows and otherwise. And then if you've been a fan of the NFL for a period of time, you know that We've kind of gone from a situation where we were hosting exhibition games as NFL franchises to hosting league games overseas and abroad, and most recently in Barcelona, Munich, and Sao Paulo. So, the global reach, I would say, is not just a one-way street, us pushing it across other continents, but it's really us adopting some of these as our own and helping with the proliferation and excitement around it all. 20 years ago, it would be unheard of to think that the NFL games wouldn't be on CBS anymore. You wouldn't have games being played on a Thursday night. So we've kind of gone from a situation where now we almost have NFL games every night of the week, or certainly NFL shows every night of the week. And that's thanks in large part to the four firms that you see here, the four media companies you see here. Even with Netflix adopting this, they're paying $150 million for two games in 2025. That's the Christmas Day games that they've taken on. And they're going head to head with the NBA, and they're totally fine with that. YouTube has the Sunday Ticket, and I suspect we'll see even more and more. I mean, there's tons of media companies that are trying to capitalize on this, and this is where we see a lot of opportunity.
Tyler, if I may, I'll just
Please.
add one or 2 points to that slide. When you're talking about Apple, Netflix, YouTube, Amazon, and others, these platforms bring the US sports properties to international markets instantly, driving both brand revenue and international fan monetization. And also, when you're thinking about these sports and truly how we watch sports today, sports content remains the last DVR-proof live asset, right? If you guys are like me, I can't even think of the last show I watched on traditional TV live. I record everything. I fast forward through all the commercials. Advertisers certainly know that, but they also know that when it comes to sports, we don't like to watch it late. We want to watch it live. So advertisers realize that these platforms pay a premium because sports retain real-time viewership at a scale and unlike most other entertainment contents.
Yeah, it's a great point. I definitely fast forward through commercials, and I would much rather watch a game live than on demand. I don't know if all of this was targeted at me personally, but I can certainly relate as a sports fan. There's also this concept of new demand, which I know we touched on the international viewers, and certainly women's sports is not anything new. But what we have seen is through NCAA basketball, we've seen viewership up 300%. I mean, think about that. That's remarkable. That's like the demographic of people from 18 to 24 that are tuning in to sports and are locked in on some of these games. The other area is youth monetization. If you have kids that are playing youth sports, you can certainly relate. Hockey, volleyball, lacrosse are some of the fastest growing youth sports around. Heaven help you if your kid is playing club soccer. It has exploded, as evidenced by MLS taking over some of the youth soccer ranks. I think right now there's like 1,400 clubs that are playing a tournament in Arizona. So if you just think about the magnitude of that, you think about what that does for the local economy, where the revenue opportunities are, and obviously the cultivation of fans and players alike at the youth level. It's really interesting. And I know we're not here to hear Tyler's prognostication on some of these things, but I would suspect that some of this ownership structure that we're talking about at the highest levels is going to start making its way into the youth levels as well. So it definitely brings us to this area of, okay, so we saw all these trends, we see all this activity, we see this as being a very interesting and viable opportunity for us to leverage and invest in. And so what we did is we created a fund. We call it the Goal Line Growth Fund. And really, as it says on the screen, it's a multi-manager, multi-strategy private equity fund to generate attractive returns by investing in what we call the business of sports. And what that really turns out to be are these four areas here. It's franchises, as we've talked about, it's technology, it's media and adjacent. So all those things that happen sort of with respect to media. I mean, blurring the lines, talk about blurring the lines. Media is definitely a blurred line between sports betting and technology and the TV programming and the commercials, and then the real estate around it. So you look at some of these deals that have been done, SoFi being sort of a hallmark example, is they're revitalizing an entire area within a major metropolitan city or maybe on the outskirts of a city to build mixed use retail and other opportunities. Even if it's just parking and transportation, there's a lot of opportunities around that too. With all of that said, I want to bring Steve Dymant into the fold here because he was very instrumental in putting this all together understanding and identifying these opportunities. Steve, what else do you want to share with us with respect to these four areas that we're looking at on the screen? Before I let you, fully embrace this question, I want to just say we have an allocation of capital around this as well. And so we're thinking about this now in terms of a really strategic investor. So with that, Steve, please let us know any additional thoughts you want to share.
No, I appreciate it, Tyler. Thank you. I mean, again, when we were thinking about this for our own clients, how best to express our views in the sports ecosystem on behalf of RIA clients. And what we found was that if we wanted exposure to the sports ecosystem, we could invest in and limit ourselves to just franchises and teams. But we realized it would be much more attractive for our clients to be in a situation where it's a much more diversified portfolio across these four verticals so that we could get exposure not only to teams and franchises, but sports technology that would add actually value to portfolios, as Tyler mentioned, media and entertainment, and even sports related real estate. And by providing a more diversified portfolio, we could create a more attractive risk adjusted return for our clients with more diversification and limited correlation to the public markets. And therefore, as an RIA, we built this for our clients, and we think it's very attractive for other RIAs and their clients as well.
Yeah, and you touch on diversification. I know that's going to come up again as we talk about another sort of angle of diversification. This is basically the construct of what we're targeting in terms of an allocation across the areas. So why so much being allocated to the franchises? Is that still sort of the golden goose of all of this, Steve?
Sure. So there are two ways that we decided we wanted to attack this. First and foremost, we wanted beta exposure to the sports ecosystem. And we felt the best way to do that was to invest in teams, leagues, and franchises. So if you think about Tyler's earlier screen, we're investing in the NFL, Major League Baseball, the NBA. We'll potentially invest in MLS as well as North American hockey. The idea is that type of investment we believe will generate 12 to 14% year over year with limited volatility. But we also realize there's opportunity for alpha within this portfolio. So about half of our teams and leagues will be in those established leagues that I discussed. And then half of it will be in earlier stage leagues. It might be women's basketball, women's soccer. We've invested in professional bull riding, sailing, chess leagues. So the idea here is that we want that consistent return in the portfolio that as these major sports leagues continue to go up in value, we are part of that. But we also wanted to provide, again, not only alpha, but diversification. So in addition to those more emerging leagues, we're also investing in sports technology. It might be something along the lines of analytics. It might be sports recovery for professional athletes. It may be, apps that you can find on your phone in terms of working out. Certainly, media and entertainment and real estate round out that investment. And we think together that will provide not only beta to the sports ecosystem, but incremental alpha that will allow us to provide very attractive risk-adjusted returns for our investors. And then as Tyler mentioned, our approach is going to be about 90 to 95% of that will be with partners or managers that we believe are best in breed in these four different verticals, as opposed to only being invested in one vertical. And then the balance, about 5 to 10% of that, will be invested in direct investments or co-investments with our partners.
Yeah, and I think that's an important part. And I want to get to that part in our presentation because I really want to sort of hit home on this level of diversification. So obviously, we're providing exclusive access. This is an opportunity to invest in the business of sports and all the areas that we just talked about. We're trying to make it as approachable as possible for the retail investor. It's backed by institutional intelligence that goes beyond the team here at Alpha Summit. We're leveraging the expertise of many of the funds that we're co-investing alongside of. And with respect to that, we're diversifying among the sectors within the business of sports, as well as the opportunities or the managers. And so that, really kind of summarizes onto what you see on this slide. And so when people ask us, well, why this fund? We know there's a few other funds that are out there. Well, it's really because of these 3 points: access, intelligence, and diversification. And I want to unpack the diversification with respect to the multi-manager approach, because I think this is a very unique differentiator. A lot of our clients, or a lot of the clients that have come to us, have said, well, I get approached all the time to invest directly in the business of sports. Why wouldn't I just allocate some of my portfolio directly to that? And part of that is to create this part of the reason we would not recommend that and recommend going into a fund-based approach that not only is diversified across sector, but is also diversified across managers, is to create that safety net of diversification. You're not putting your proverbial eggs all in one basket. And so, Steve, talk a little bit more, if you would, just about this multi-manager approach, like why it works, and then we'll unpack the how.
Sure. I mean, in terms of the multi-manager approach, as well as why we put this into a fund, is that for most of our clients who wanted to get access to sports, unless they wanted to write a $5 million ticket or a $10 million ticket, they couldn't get invested. And even if so, it wasn't into some of these bigger leagues, the NFL or Major League Baseball. It was very emerging type assets, and they were single assets. So by pooling everyone's funds together and then generating this through a multi-manager approach, clients can get, for a much smaller dollar amount, exposure to 4 or 5 different managers, 30 to 40 underlying investments, as opposed to a single investment. And the idea behind this is picking those managers who have repeatable processes over and over again, and an area of expertise that we can underwrite, provide, do our due diligence on, gave us a lot more comfort so that a single asset wouldn't have too much of an impact. But more importantly, we could actually expose client assets to a multitude of managers, which would give them, again, a lower risk profile, lower volatility, but clearly we believe higher opportunity on the upside.
Yeah, that makes sense. And like any good investment firm, we start with sourcing, we conduct our detailed due diligence, and then we deploy our capital based on what we see. And to further support that, like any good investment manager as well, is we have a 6-step process for doing that. And it really starts with a track record. So we're attracted to those firms that have done this before, that understand this space. We look at the management team, we look at the strategic fit among the other areas where we've deployed capital. We're obviously seeking tailwinds in the opportunity. And as we talked about earlier in the presentation, there's no shortage of those tailwinds right now. We want to make sure there's operational efficiency and execution that is commensurate with what retail clients would expect and what RIAs need to be successful. And of course, it all sort of comes down to having the right alignment around everything. So this, 6-step process is important. And what it does is it leads us to giving access and exposure to clients across this wide array of very, very notable names. And as Steve was alluding to, some of the emerging names. And so, Steve, walk us through what you're seeing here. Maybe you want to share just a couple of highlights from some of the opportunities that we've been able to get exposure to that we see on the screen here.
Sure. And again, as a perfect example, if someone were to write a $5 million ticket, they couldn't get exposure to the NFL, right? They couldn't get exposure to Major League Baseball. So through the partnerships that we've developed in our investments, as you can see here, even for a smaller ticket size, $250,000 ticket, $500,000 ticket, clients are able to get access to a broad set of exposures across, again, different leagues, technologies. There's areas of exposure that we've discussed already, earlier. And for us, it's finding those partners that have those experiences, who are not looking at these as trophy assets, but looking at them as a financial asset to generate very attractive returns. And what I will say is that with some of the managers that we partnered with, while their funds might only be 3 or 4 underlying investments at this time, our portfolio, by the time we finish this year, will probably have north of 35 underlying investments across, again, both established leagues like the NFL and Major League Baseball, but some of the emerging leagues that you can see in the middle of the page, Sail GP, the New York Mavericks happen to be a bull riding team within the professional bull riding circuit, and also sports media content is part of the portfolio. For us, this is not the entire portfolio, but it's a good way to show that for a smaller dollar investment into a fund, you can get that broad-based exposure across multiple verticals, across multiple managers, and hopefully provide the best risk-adjusted returns for our clients.
Yeah, that's well said. And one that I would call out on this, obviously, there's some very notable names here. One I'd call out is Cosm, which is that virtual fan-based theater experience. It's been prominently featured in a lot of different areas, but most recently it's been featured in soccer events. They even were broadcasting the FIFA World Cup draw from a couple of their venues. So, some really exciting, cool ways, and just an anecdote, if you will, of what our clients of Goal Line Growth get access to as they invest. So, we want to wrap this all up by showing a couple of things. We want to show, who this is for. If it's not clear yet, we really want to help you identify what that looks like. And we want you to know that we can work with you to help identify and educate as well. And then we're going to talk about, why now is the time and then what next steps. So as we wrap it up, I want to just share a couple of highlights from what we've seen as we've rolled this fund out. We see what you're seeing on the left is basically a summary of the client and who this is attracted to. Next gen wealth is an interesting one. It's really oftentimes the children of perhaps the matriarch or the patriarch of the family's wealth who are wanting to do something a little bit different with the family's money. And this has piqued their interest. Entrepreneurs, again, those are ones who get pitched a lot on opportunities to sponsor or invest. I mean, if you own a company, that's generating 10 million plus dollars in revenue, not necessarily a big company, but potentially a small business, you're going to get hit up at the local sports team to sponsor in some way. And so they're typically well versed in sort of what the opportunities are for the business of sports. And so they're gravitating towards this as an investment opportunity, not for their company, but for them themselves. And the client personas opportunities exist with sports enthusiasts, obviously, if they have brand affinity, the next gen wealth inheritors, as we call them. And, the conversation to talk about alts in a standard portfolio or a typical portfolio is a different conversation and, perhaps the subject of a different webinar. But, that's who's seeing this. Somebody who wants a little bit more octane. They want something thematic. They want something that they can talk for advisors. They want something they can talk to their clients about. And then for the clients, they want something that they can talk to their friends about because it's much more interesting than talking about oftentimes mutual funds or other areas. So that's who we see as the ideal client persona. Obviously, this is subject to what your clients are looking for and who this is the right fit for. But we wanted to just share some of our initial research of what we see. So with that, I want to talk about why now, because this window of opportunity isn't evergreen. It's not going to be here forever. It's not going to be as wide open as it is. Historically, that's just never how things are. And so we do see now media is at an inflection point. We see there's an openness to outside capital, but we also see that the minority rules might be changing. So some of them are becoming more favorable. But again, it's oftentimes a pendulum with these things. As you guys know, you invest in companies all the time and you understand sort of the cyclicality of some of this. Fan growth, we've talked about the PE platforms that have invested are in some cases nearing their cap and they're going to have to do additional rounds of funding. Moz, is there anything else as I sort of bring you back into the conversation here at the end of the webinar, just anything else on this slide that you want to highlight or point out?
I'll just simply say that everything that you and Steve have accurately described in the last few slides as far as, what the end client is looking for, why now, it all makes sense. In a world that we're constantly talking about diversifying, it's very easy to get concentrated in a handful of platforms that feel like they're diversified, but they truly are correlated, whether that's stocks, bonds. Alternative investments as an asset class that generally is something that is truly diversifying a portfolio, making it less correlated, making it generally less volatile to a traditional investment of a basket of equities and fixed income. So for us, dialing it down even further and make it more granular and bringing it down to sports allows us to truly bring something unique to the table that adds value in that alternative asset class.
Yeah, that's great. And, I think we talked about the process, we talked about the opportunity. The people behind the opportunity is Alpha Summit. We'll do the sourcing, we'll do the diligence, we'll help with implementation. And behind Alpha Summit is the many years of experience of Steel Peak. So the investment professionals at Steel Peak are really helping with trading and execution, legal and compliance, and helping make some of the analysis around what the investment committee ultimately decides to do. I know this is one area where clients will want to know more details about, whether they're the end retail clients we're talking to or RIAs and the advisors that work for them. Steve, maybe you can just hit on these points real quickly about some of the fund structure, and then obviously we'll be able to share more details as a follow-up to this presentation.
Sure. Our fund structure looks and feels like your typical private equity fund. It is a $250,000 minimum. It is a drawdown capital call structure so that if an investor were to commit $250,000, they don't put that money all up front day one, but as investment and opportunities come up and we make those investments, we call capital from the clients. It's a 10-year structure like private equity. The reason for that is we want to be patient capital. We don't want to be in a situation where time is running out and we don't want to be in a situation where it's a forced sale. So that 10 years allows us to be very, very patient. In terms of the fee structure, similar to what we charge our own clients, there's a 1% management fee that's on committed capital for the fund. And then at the liquidation of the fund, if investors are up on their capital, they'll be charged a 10% carry. Again, that is only on liquidation and as they're making profits. Finally, and I mentioned the capital call, finally, there's a K1. Clients will get a K1 each year that represents, obviously, their gains and losses on a realized basis in the fund. And that is something that is part of our fund structure.
That's helpful. And again, we'll be able to provide more details in the fund materials around this. We just wanted to make sure we touched on it because we know it comes up as a question, after people learn about the opportunity itself. So in terms of next steps, again, we thank you for your time. We thank you for your interest in this fund and the business of sports. And so what we will do as a next step is we'll follow up. You'll receive an outreach from someone on our team. We'll be able to grant you exclusive access to the marketing materials and the data room that we have set up for the fund. We'll work with you to identify clients. We can even provide educational seminars, much like what we just did here, to talk to some of your top clients to see if there's interest and to help gauge interest. And then if all things look good on your end, we'd be working with you hand in hand to onboard. So with that, again, we thank you. We will invite you to schedule a meeting with our team, but we will be following up with you. With that, I'll leave Moz with the last word as we conclude our webinar.
Thank you, Steve, for your time, and thank you to all the attendees for allowing us to show you what we're doing that we feel is very unique and hopefully of value add.
Thanks, Moz. Thanks, Steve. This concludes the webinar. Thank you again for joining us.